Hello and welcome to Accounting Discussions. We'll try to understand in this session the impact of financing decisions on economic value added. When we say financing decision reflects the composition of the sources of money. It can come from debt or equity, and within the debt may be long term or short term, or within the debt it may be interest bearing liabilities and non-interest bearing liabilities. So whether the sources of money has any impact on economic value added, or to see how EVA will change with the change of financing decision is the focus of this session. So we can see that in this case the business is financed by significant amount of the assets are financed by equity. So that means 72% of the business is funded by equity. The other sources like long-term and short-term loans accounts for 28%. So with this capital structure, the EVA is negative, minus 8,215, where the return on equity is 16.9%. And the equity consists of a significant part is the capital, and reserves is 258,000. Let us see this balance sheet. In this case, the equity is same, but capital is only 100,000, whereas the reserves are 658,000. A significant part of the equity is in the form of reserves. So in this case, reserves is only 258,275, whereas in this case it is high reserves. That means the business is funded by own profits, but the equity is same. Since the equity is same, the EVA, which is based on the cost of equity calculation, since the equity is same, the EVA is still continues to be negative, minus 8,215. So the weighted average cost of capital in this case is 15.1%. 15.1%. In the previous case also it is 15.1% because there is no change in the equity, but the composition of equity changes. So whether high capital or high reserve, EVA is same, minus 8215. Minus 8215. Now we'll see the third balance sheet. In this balance sheet, the sources are same, the total source, but the composition of the total sources is not same. Unlike the previous two balance sheets where there is no creditors, here a significant amount of the business is financed by the creditors. So creditors account for 41% of the business is financed by the short-term creditors. So creditors account for 41% of the total sources. Because of the change in the sources of financing of the business from the equity to the short-term liabilities, there will be a significant change on the economic value added. We can see that economic value added becomes positive, but here economic value added is positive because significant part of the business is financed by non-interest bearing liabilities. So we can see that weighted average cost of capital has come down to 13.08, whereas in the previous case it was 15.1%. So With the change in the composition of equity, EVA is not changing, but with the change in the financing structure, the EVA is changing. But is this positive EVA good or bad? That depends on how is the company managing its suppliers. There's every possibility that continuous non-payment of money to the supplier may result in supplier stopping the supply or supplier increasing the price, which may lead to increase in costs, or sometimes supplier taking over the business. So managing EVA is not just managing the financing decisions, but also to manage the operations and other strategic issues involved. Thank you very much.